Taxes on investments can seem like something dangerous that can eat away at your profits or cause you to get stung by hidden fees because you didn't follow the right rules and regulations. But in reality, taxes in New Zealand are very straightforward, and for the vast majority of investors, they don't actively have to do anything to get their taxes sorted. For most people, all their tax information is done automatically without them having to fill in any special forms or declare anything. It's actually a very straightforward process and something that's easily done in the background without you actually having to do anything on your part. The two main criteria where you actually have to do some paperwork of your own is if you have 50,000 New Zealand dollars in cash invested in overseas companies, or if you receive a dividend of 200 New Zealand dollars or more. So jumping into the first example, having over $50,000 invested overseas, essentially this means any investment outside of New Zealand is classed as an overseas business. So if you're putting your money into companies like Google, Facebook, Coca-Cola, these are all American companies and are therefore classified as overseas investments. Unless you're investing specifically into the New Zealand stock market through companies like Fletcher Buildings, Ryman Healthcare, or Fisher & Paykel Technologies, then it's going to automatically be an overseas investment. And the amount of $50,000 is based on the cash investment that you put in. So as an example, if you put in 30,000 New Zealand dollars into a company and then it doubled in value, and now your portfolio is worth 60,000 New Zealand dollars, you still haven't quite reached the threshold where you actually have to declare that or do paperwork to make sure your taxes are done properly. In fact, you could invest another $20,000 before you'd actually have to do some paperwork to get your taxes done. Because if you just put in $30,000 initially, you still have another $20,000 to go before you've reached a total cash investment of 50,000 New Zealand dollars. Because it's not based on the total value of your portfolio, it's just on the cash amount that you put in. The money that you have invested through your KiwiSaver does not count towards this total of $50,000. It's only through voluntary investments that you pick on your own using a brokerage platform like Sharesies, Stake, or Hatch. I also received a question if you can just split your money between different brokers to try and limit the amount of money that your portfolio is valued at, meaning to see if it was possible to just put $49,000 into Sharesies and then $49,000 into Hatch to try and extend the amount of money that you have invested before you have to declare tax on it. But it's the total value of your portfolio spread out amongst any voluntary brokerage platform. So if you have $25,000 in Hatch and $25,000 in Sharesies, you still reach that total amount of $50,000. It's not per brokerage platform, it's total amount of money that you have invested. Because it can be challenging to actually keep track of how close you are to meeting the threshold of needing to declare tax if you've got price fluctuations in your portfolio, Hatch and Sharesies have a dedicated tab that helps you get your taxes sorted and gives you all the necessary information to make sure when tax time comes around, you can declare everything properly. It shows you how far you are off meeting the thresholds to pay tax or declare tax personally on your investments so that everything can be as smooth as possible. You can also email them or check out their websites as well, and they give you detailed breakdowns of all the things you have to follow to get taxes sorted when it comes to your investing. If you do fall into this category of having a net 50,000 New Zealand dollars invested overseas, then you have to meet the requirements of a foreign investment fund. And this is essentially a calculation that you do to figure out how much tax you have to pay on your overseas investments. IRD has a calculator to help you with this, so you can figure out the total tax amount that you have to pay. But ideally, it's best to seek the advice of a broker or a tax advisor that has experience with overseas investments so they can steer you in the right direction and answer any questions that you might have. IRD also has a page dedicated to foreign investment funds to give you all the info to fill out the forms properly. For the foreign investment fund, the period of time where the tax year starts and ends is from the 1st of April to the 31st of March. The second criteria where you have to do some paperwork to declare your taxes is if you receive a dividend payout of $200 or more, and the dividend is essentially a payback to a company's investors from the company's profits. It recognizes the investor as part owner in that business, so when it's making a lot of money, it shares its revenue with its investors in the form form of a dividend, and a dividend is typically expressed as a percentage. If you want to see which companies pay out a dividend and how much they'll give you, this information is readily available on all major brokers in New Zealand, including Hatch, Stake and Sharesies. It's clearly displayed on all these different brokerage platforms, and you can also do a quick Google search and it'll show you if a dividend is offered by a company and how much it's going to pay out. So the reason that you have to pay money on a dividend payout of $200 or more is because it's untaxed income. If you do work that's technically under the table and you get paid in cash, that's also classed as untaxed income. Income that's taxed before you receive it obviously includes things like your salary, KiwiSaver contributions, and interest on a savings account. The form that you need to fill out to get your taxes sorted on a dividend payout of $200 or more is an IR3 or individual tax return form. And this just asks you about different sources of income that you might have, like rental income or of course a dividend payout. It's quite straightforward, and I'll leave an example to one down below in the description box, and they're free to download from IRD, and it's always best to get the advice of a tax advisor or a broker that can help you fill out these types of forms. So for most people, you're not going to have to fill in an IR3 form. However, the circumstances where you would have to is, for example, you invested in a high dividend yielding company. Take McDonald's for example, which offers a dividend of 2.17%, meaning that if you had $10,000 invested, you would get a dividend payout of $217. This means you would have to fill in an IR3 form, but you can easily calculate how much dividend payout you'll be getting from your investments and if you're actually going to meet this threshold. So those are the main examples where you actually have to do something on your own to make sure your taxes are sorted properly. Now, some common misconceptions when it comes to paying tax on stock market investments is that people might think that the amount of tax that you pay is related to how long you hold an investment, similar to the way that you have to pay more or less tax on your capital gains from selling a property depending on how long you held onto it. But with the stock market, the rules aren't so concrete, as I found out personally when I bought into the hype last year and purchased a few shares of GameStop. I had only held my investment for less than 24 hours before selling at a profit. Now, because I had quickly bought and sold the company, and it was a very volatile company at that, I thought there were potentially some tax obligations that I had to meet because I had the behavior of a trader, which is something that IRD talks about on their website, and they classed a trader as someone that quickly buys and sells stocks of volatile companies. So I emailed Hatch to see if there was anything that I had to do to declare tax on my profits, and they replied saying there aren't any concrete timeframes in terms of how long you hold an investment before IRD will start to class you as a trader, and it's very much a grey area for IRD, and it's judged on a case-by-case basis. On IRD's website, their main classification is for a trader someone that has an investing strategy in a professional way, and they invest a lot of their own money or money that they borrowed, and they do it consistently. If you're someone that buys into a meme stock here and there, potentially you put some money into Dogecoin or into GameStop, then you're not going to really fall under that category. So again, for the vast majority of people, more likely than not, you won't be classed as a trader and won't face any of those tax penalties that they might have. There's also no structured tax brackets in terms of how much profit you make and how much tax you have to pay when it comes to investing, the same way that people have with their salaries. Again, it's very much a grey area, and there's no set amount of money that you have to pay based on the profit that you've made. It's not like if you make $20,000 you have to pay 20% tax, and if you make $50,000 you have to pay 40% tax. It's not judged in that way, and it's very much again a case-by-case basis for IRD when they judge how much you're going to have to pay on your profits. Now that you're familiar with how to get your taxes sorted in New Zealand, it's important to know how to actually invest in the New Zealand stock market. Check out this video on screen where I'll show you the exact steps to buying shares in the New Zealand market, how to get the money together to actually invest, and some recommendations on the best companies for beginners to buy to get started with on their investing journey. Remember, if you find the content helpful, make sure to drop a like for the YouTube algorithm.